Welcome back to the Accounting Working Group podcast. I'm your host, Stein Smith. And and as 2023 wraps up, it is, I think, pretty safe to say that this past year has been an intense one for the blockchain and broader crypto asset space, right? I mean, from bankruptcies to convictions to plea deals, and on the other hand, some uh, regulation coming out that's positive and also negative, and also TradFi firms really wading in deeply into this space. There has been a lot going on in this past year, and there are some really important changes coming for 2024 and beyond that anybody who is either investing in the space, interested in the space even, or is trying to uh, advise clients in this space really are going to have to watch out for going forward. So obviously, the top headline stories of this past year, unfortunately, continued to be FTX, and then Binance also was added in there as well. So FTX, it is finally wrapped up. Bankman-Fried has been found guilty on all of the charges filed against him in the court of law. And so the only drama left, hopefully, in this odyssey is to find out how much time he will actually serve in prison for his crimes. And Binance also was, after many, many years of being in hot water and probed and chased basically around the world, Binance as an institution and Changpeng Zhao both have pled guilty to criminal charges, including violations of uh, money laundering statutes, terrorist financing charges, and numerous other financial crimes. And it is worth pointing out that also Binance received and has to pay the largest ever fine, I believe, in history, that was filed by FinCEN. So obviously, it was a huge year in terms of trying to shake out some of the bad actors in this area. But of course, as these headlines play out, and as clips from courtroom trials and multi-billion-dollar fines and heads of companies pleading guilty to criminal charges are in the headlines and being talked about, that obviously made it a rough year for crypto, sort of in the marketplace and in terms of the optics. But on the other hand, right, there have been quite a few positive headlines on Bitcoin. And, obviously, positive or negative is going to depend on how you and your clients feel about TradFi and about more, what's it, centralized players in the space. But ultimately, having institutions like JP Morgan rolling out and then really pushing their own tokenized payment options, having PayPal building on their prior efforts in the space, rolling out back in August their own privately issued stablecoin, and having other financial institutions like BlackRock, Invesco, WisdomTree, Franklin Templeton, all turning in applications for a spot Bitcoin ETF. All of those trends, might not echo the original ethos of the Bitcoin white paper, but I would argue that it at this point, um, in the context of the SEC and of Congress being at the very least anti-crypto, and if not absolutely trying to stomp it out here in the U.S., that having TradFi players in the space is a good sign for adoption, regulation, and I would say more transparency in this ecosystem going forward. And it's always worth highlighting and watching, both for you and any clients who might hear, certain bank CEOs talking about Jamie Dimon, offering his own point of view that he would personally outlaw and ban crypto if it's up to him, while his bank has been actively rolling out those exact products and services and options uh, for their commercial clients. So it's always good to have an eye on the headlines, right? And there have been quite a few. FTX, Binance, the SEC, and all the rest. But it's also good to watch what else is going on in the space, right? Either at those institutions in question or just overall, right? Right? Because I would say that I'm cautiously optimistic at the end of this current year, right? That the bad actors, two of the most questionable and turned out to be bad actors in the space, have been, for all intents and purposes, flushed out. And so now, hopefully, there is an opportunity to have a more productive and uh, mature dialogue around crypto assets, blockchain, and how these instruments and assets can be better integrated into the U.S. financial markets. And even more positive news, right? The FASB finally, after years and years and years, including a letter submitted by Ron and myself all the way back in 2019, finally the FASB has issued the first and only crypto-focused gap guidance, and it's about 51 pages long. And after going through it myself, I actually ran it through ChatGPT and asked it to summarize it for me into 10 bullet points. And so the real takeaways here are that one, this ASU takes effect for all fiscal years starting after 12/15/2024. So in about 12 months. And pretty much the two big changes here are that one, if you are a company that holds qualifying crypto assets, right? And so I would encourage all of you to understand sort of what those qualifying criteria are. But if you're a institution that holds qualifying crypto assets, you are able to now mark them to market, which is a very obvious practice, but but that but that due to the nature of crypto, it took an entire ASU to have this very obvious treatment be codified and implemented into the marketplace. So I'm very happy on this point. I believe it's an excellent first step towards trying to get more guardrails, frameworks, transparency, whatever adjective you want to use around how these assets are going to be shown and then ultimately communicated out to investors, regulators, and any other uh, interested parties. And then two, there are some criteria that are going to have to be shown for a company that holds crypto assets on their balance sheet. And obviously, depending on the nature of the tokenized asset itself, there are going to be different types of information that are going to have to be shown. But ultimately, um, they're having more transparency and more information around crypto asset, be it the actual token in question, cost basis, number of units, and then how those balances are changing. Um, that's ultimately going to help, right? Bringing more transparency into this space. Now, obviously, accounting rules and reporting requirements aren't going to stop bad actors like the team at FTX who just flat out conducted fraud, but it is going to give regulators, investors, creditors more tools to examine how a company is actually doing. And if they aren't publishing all of this information, then that should be cause for pause. Okay, so the ASU, I think, is an excellent first step. Now, on the other hand, there's been a lot of controversy and consternation around the upcoming changes to IRS Code Section 6045. And I'm sure all of you have heard about it, but there are sort of two main points from a client advisory point of view, right, that I think are worth keeping top of mind, even though as it's currently written and it's currently going to be implemented, and obviously the interpretation and the enforcement of these changes are the real action items. But as the changes are currently written, and it will take effect for all transactions after 1/1/2025, that basically the IRS wants a lot more information on the traders, both both their trading history and on those individuals from both centralized players and from DEXs, right, decentralized trading platforms. And a obvious problem there is that most of the decentralized players in the space are not equipped and do not have the functionality to collect, much less communicate out all of this information out to the IRS. So one, it's a big problem, and all of that goes back to the whole broker conversation and debate, and that broker debate has been underway ever since this change was introduced in the bipartisan infrastructure bill all the way back in the fall of 2021. So it has been a long, drawn out process. And even though the IRS has received, or had received rather, over 100,000 comment letters on this change, they have not indicated externally that they are going to make any uh, fundamental changes to how these changes are going to be implemented. And then the other big change there is that going forward, again, as these changes are currently written, that pretty much crypto investors are going to either have to use FIFO, first in, first out, or have to go through and actually identify every unique token prior to the trade. So, okay, so FIFO will overall, assuming you have clients who have been buying crypto for a while, and as opposed to having somebody who bought all their Bitcoin in April 2021. But overall, earlier purchases are going to have lower cost bases versus current market prices. So if you have investors who are forced to use FIFO by default, that will overall, on average, create larger income tax liabilities. Okay, so obviously that is not great from a tax planning point of view. Okay, so option two is to go through and to try to identify every unique crypto asset prior to the trade. Okay, well, the only problem there is that even the centralized players, like Coinbase, don't have that functionality yet. And so that means that if you want to do that, that's going to create a instance where you have trading records coming out on 1099 DAs from these centralized players that aren't going to be correct from a income tax point of view. And so then you and your client have to go through and to try to figure out which Bitcoin or token or any other crypto asset actually had been involved in that trade. So manual work and a lot of reconciliations. And then adding on to that, if you have clients who are, as a direct result of the increased information collection, moving funds off of DEXs into platforms like Kraken or Coinbase or any other centralized player, that could also create a instance where you have 1099 DAs coming out that are not correct from a tax point of view. You and your client have to manually try to work through which tokens were involved in those trades. And then three, you can have cases where as tokens are transferred over, they come in at a cost basis of zero, throwing off any other trades going forward. So that's going to be a massive headache going forward, starting again for all transactions occurring after 1/1/2025. So that's why I'm calling, just informally, 2024 is the year of preparation, right? Both on a GAAP point of view and on a tax point of view. That it's up to us in the space to really try to one, educate ourselves, two, educate our colleagues, our staff, and three, then after all of that is done, and only after that, have calm conversations with our clients to one, educate them, and to two, try to work through how best to comply with these upcoming changes. But ultimately, I'm cautiously optimistic for 2024 going forward. Um, uh, there are quite a few positive headlines out there, both on the institutional point of view and on the uh, regulatory point of view. Even though uh, the folks at the SEC seem bent on crushing innovation at every turn, there are positive developments happening anyway. And so, just a few quick updates here before I wrap up. The accounting working group has some uh, exciting things planned for Q1, Q2 2024. We are trying to get the breakfast briefing series back up and running in person, so have an eye out for that. And I'm also planning to organize a tax panel during the first quarter on some of these questions around 60-45. So, and then we also have some pretty interesting work streams coming up probably during the back half of 2024. So it's going to be another jam-packed year, both for crypto and for the accounting working group. And have a festive and safe end of year. And I'm looking forward to a exciting and dynamic next year. And have a great day.